Well, the bottom line is that growth and inflation remain uncomfortably weak in the Eurozone, especially in Italy and Germany, which are close to recession. And there are also downside risks to growth going forward, which could push Europe as a whole into recession. These include the ongoing risk of a no-deal Brexit. Secondly, trade tensions between the US and China continue to escalate. And then finally, President Trump is also continuing to threaten Europe with imposing higher tariffs on imports of autos. So in these circumstances, the ECB is uncomfortable over the outlook for inflation, and they feel that they may have to take action to lift inflation back towards their target. If we look at inflation right now, that's well below target at around 1%, and inflation expectations have been falling. Well, we expect President Draghi to want to go out with a bang before he leaves the ECB. So we are expecting him to announce a comprehensive package of easing measures. So firstly, we think he will announce that the ECB are going to cut the deposit rate by at least 10 basis points, although we think it could be cut as much as 20 basis points. And they will also look to introduce a tiered deposit rate system to try and dampen the negative impact of those deposit rate cuts on banks' profitabilities. Secondly, we think the ECB will also want to restart the quantitative easing programme. That could include announcing asset purchases of 20 to 30 billion euros per month for an initial period of, say, 6 to 9 months. And then finally, we also think that the ECB would look to try and strengthen their forward rate guidance. At the moment, that forward rate guidance says to the market that they expect rates to remain on hold or be lowered at least through the middle of next year. One easy way to strengthen that guidance would be to lengthen the duration, say until the end of 2020 or beyond, or alternatively they could try to link it more strongly to achieving a certain rate of inflation. Financial markets are already expecting an aggressive package of easing from the ECB this week. We think that represents a high hurdle for the ECB to exceed or even meet those expectations. Firstly, if you look at short rates in Europe, those are expecting the ECB to cut rates by at least 10 basis points this week, with a possibility of an even 20 basis point cut. Secondly, if you look at longer term rates in Europe, we've seen those also fall very sharply over the last month or so to new record lows. Again, that highlights that financial market participants have already priced in an aggressive QE program from the ECB. And then finally, the value of the euro has already weakened in anticipation of the ECB policy announcement this week. We saw it briefly dip below the 110 level. It highlights that markets are already anticipating this package of easing to come. And going forward, we think it's going to become more and more difficult for the ECB to continue to push the euro lower against the dollar. At these levels, we think the euro is already deeply undervalued against the dollar, and that makes us reluctant to forecast levels below 105 to 110. In fact, with regards to the risks from this policy meeting, we think they may actually be more to the upside. If the ECB disappoints, then there is scope for the euro to stage a brief relief rally at the end of this week. The biggest risk of disappointment is with regards to the quantitative easing programme. We've heard from ECB officials over the last couple of weeks, and some of those have expressed concern over restarting quantitative easing at this point in time.